Hello everyone. This video we are going to look for deferred tax asset as well as deferred tax liability. That's a thing we are going to look in this video along with a couple of examples, and this is very useful those who are preparing for accounting subject or otherwise the people those who are studying for schooling as well as those who are preparing for competitive examination. Okay, so this respective term is very helpful, and we can go ahead and see each and everything in a very simple way along with the examples also. And after that we can look for the questions, as well as I will give you 5 questions to you how you can understand this respective terminologies. Okay, so this is what we are going to look over here with this presentation. So in order to waste the time, we can move forward. What is deferred tax? So deferred, in a sense, we can say as postponed. So we are going to postpone for respective things. Postponed in a sense what? For tax, normally the money which is paid to the government. Okay, so we are postponing the tax right now. Anyhow, we are going to pay. Okay, so right now you can understand the term call it as deferred as postponed, and tax in a sense money which is paid to the government. So what is deferred tax? That is a tax you will pay later or save for later. Okay, you're going to pay later or save for later. Save for later in a sense what? You're going to pay right now, and from the future you will get it for the benefit. Okay, or else what is that? You're not going to pay right now, but in the future you're going to pay. Okay, so that's the thing, the temporary difference. Okay, in order to pay for a tax, that we call it as deferred tax. Why it will occur? Okay, sometimes accounting profit and taxable profit are different. Suppose if you are running for the corporate, or else whatever company is running, they will prepare for two books, one for accounting books and another one for taxable purpose. They will prepare for the books of accounting. For accounting book, what will happen in a sense, they will maintain for IFRS standard or GAAP standard, that is generally accepted accounting principle. That accounting principle will be there, right? As well as international financial reporting standard will be there. Which country is following? For GAAP is followed by India, IFRS followed by US in a sense. So depends upon the country, they will follow for accounting books. Okay, that's called accounting book. And the tax book depends upon the country and depends upon their rule of tax, they will prepare for tax book. So the difference between accounting book as well as for the tax book, that they will call it as deferred if it is an asset perspective, as well as for liability. If you want to pay in a sense, it will consider as a deferred liability. Okay, in order to save in a sense, they will call it as deferred asset. Okay, this time difference, accounting book difference as well as for tax book difference, that's what we call it as. And legally, normally every company they will prepare for these two things. And some of the companies they will prepare that is a fake data as well as real data also, in order to hide from the government for the tax. I'm not telling that one. In a legal way, the company will prepare for two books, that is accounting book as well as for tax books. Okay, so that difference only we will call it as deferred. So normally it will be the tax effect is pushed to the future. Suppose if you are not going to pay right now, but in the future you should pay on it. Okay, that is what they have given over here. That is a purpose we are mentioning for the financial statement for deferred tax asset or deferred tax liability. So here we are going to look for deferred tax asset and liability. What is the difference? What is the meaning? That is what we are going to look over here. So DTA, that is deferred tax asset. You have paid more tax now, okay, or your expenses are recognized later for tax, so you pay less tax later. So what happened? Deferred tax asset, in a sense, you are going to pay more tax right now. From the future you will get the benefit of it. Okay, benefit in a sense, for the next year you will get the reduction of it, so you will pay less. And deferred tax liability, in a sense, you have paid less tax now, because your income is recognized earlier in accounts, so you will pay more tax later. So what will happen? Deferred tax liability, in a sense, you are going to pay tax less right now for the liability point of view. Why you are going to pay right now is very less, in a sense, your income. Suppose if you want to get rental payment for the next month only, this month, this respective month, you will get the rental payment for the next month, but in your accounting book, it will be higher. Okay, this month itself you will record, but in the tax book you will record for the next month only. So what will happen? You will pay for the less payment as per the current month. Okay, but respect to tax amount, anyhow you need to pay, but you will pay it for future. That is what deferred tax liability. And if you're looking for deferred tax asset, future tax saving due to temporary differences. So I already told you how deferred tax will happen, in a sense, the difference between accounting book as well as for the tax book. Okay, so for the asset perspective, future tax savings due to temporary, this temporary difference, in a sense, what, while you're preparing for accounting book as well as for the tax book for the current month, while you're looking, there should be a difference will be there. That's call it as temporary difference only. Anyhow you will receive for the payment for the next month, right? One example I told you for the rental payment. So it will be a future tax savings, the perspective of deferred tax asset. For the liability point of view, you can consider as payment, that is a future tax payment due to temporary differences. It means what? You're going to pay right now is less, but anyhow you need to pay for the future for the respective tax. Okay, that is a future tax payment for deferred tax liability point of view. And pay more tax now, that's what from the meaning itself we looked, that is we are going to pay more tax for deferred tax asset point of view, and for deferred tax liability point of view we are going to pay less tax. Okay, and how you can identify it, in a sense, the book profit less than tax profit, in a sense, it will come under deferred tax asset. Sometimes in the competitive examination they will ask you for deferred tax asset means dash. So you need to know the book profit or accountable profit will be lesser while compared with taxable profit. That is what you need to write it. In the deferred tax liability point of view, if you're looking, in a sense, book profit will be higher. That is, accounting profit is higher while compared with the taxable profit. Okay, that is what we can look for deferred tax liability point of view. So from here, deferred tax asset point of view, you will get the tax benefit because this year you're going to pay higher, but later you will get the benefit of it. Okay, some deduction you are going to pay less in the you will get in the future. Tax benefit you will get in the future, and liability point of view, tax you will have to pay in future because you are going to pay less for this year. Okay, so what you need to do, anyhow you need to pay for the next year for the respectable tax, so you have to pay in the future. That is what as the same thing will be available over here, that is future tax savings by the point of view deferred tax asset, and deferred tax liability future tax payment you are going to pay on it. And where it will appear, in a sense, asset, it will be available for fixed asset and current asset, right? So this will appear for the current asset, but under the current asset it is a non-current asset. Okay, it appears under non-current asset for the balance sheet. For deferred tax liability, it will appear for non-current liability. So this will also ask in one word for choose the best and all, where it will appear for deferred tax asset and deferred tax liability. So deferred tax asset, it's a future payment or future savings. Okay, such kind of things. So where it will get for tax benefit, that is deferred tax liability or deferred tax asset. So this kind of tricky question. So over here, if you're looking, in a sense, totally 3, 6, 7 we looked, okay, in which they will frame the question for more than 10 also it is possible. So main things I have posted over here, and next one we can look when deferred tax liability will be occur. Okay, there are three major real life accounting situations available. So that is what I have displayed over here. What are the three main real life accounting situation? The first one will be depreciation differences, and second one will be installment sales revenue, and third one will be capitalization versus immediate expenses. So each and everything we can look along with an example. The first one, that is a depreciation difference. How depreciation difference? In a sense, say for example you are buying for machinery for the cost of 50,000. Okay, so from the accounting book what you will mention for the straight line method, okay, for 10 percentage, okay, 10 percentage, the life of machine you can consider for 3 years. Okay, so how much it will come? For the 5,000 per year it will come. But for tax rules will be accelerated depreciation. It means we can call it as written down value method will be there, right? So based on that method only the asset depreciation will be calculated. If it is in whole 3 years, it will consider for a particular year itself. So each and every year we will take it for accounting books, but for tax book we will consider the first year itself. We will take it for whole depreciation value. Okay, so right now itself you can look the difference. The profit before depreciation, that is a cost of respect to machinery, we will enter for accounting book as well as for tax book also. But for the depreciation of accounting book it will be recorded for 5,000. If you are calculating for this one for the this one machinery point of view, from here as 50,000, just you can we can mention over here as 50,000 over here, because they have mentioned for 30,000, but we need to mention it over here for the particular year. The first year we get the profit of 30,000 while we use for this respective machinery and we produce for some items. Okay, so 30,000 profit we received. As a tax book also we are mentioning for 30,000. For after depreciation, how we can calculate? In a sense, as per the accounting book, as per accounting standard, we are calculating straight line method. Okay, while you are calculating for the straight line method, it is coming for 5,000 for the first year. But from here 15,000 we have mentioned. Why? Because the 3 years we calculated for the life of machine. So 15,000 as a whole 3 years, how much of depreciation will come? That is what we have taken as per the tax rule. So you can look over here, profit after depreciation. Once you're detecting 30,000 minus 5,000, you will get it for 25,000, and from here as 15,000 you will get it. While you're comparing this one, the tax amount will be lower, as well as profit after depreciation, that is accounting book, will be higher. While accounting profit, that is a book profit, is higher and tax profit is lower. In a sense, already we looked over here for the differentiation. Book profit is higher and tax profit is lower. In a sense, it is coming under deferred tax liability, right? That is what we looked. So that's the thing we have written over here, that is accounting profit is higher than taxable profit. So the company pay less now, less in a sense 15,000 they will pay right now, but in the future they need to pay for this much amount. That is what they are telling. So the taxable tax book, it is showing for less, but accounting book it's showing for higher. So it means what? Deferred tax liability arises. Okay, so this is for the first example with first example with the scenario. And the second scenario, if you're looking in a scene, that is installment sales revenue. For the example, you can look, the company sells goods worth 20,000 on installment. Installment basis, they are selling for a particular worth of goods. So installment basis, suppose if you're giving for 3 years, in a sense, you need to put it for 20,000 divided by 3. If it is 4 years, in a sense, divided by 4. So each and every year, how much you are going to get? That is 5,000 you will get it. Suppose if you're giving for 4 years, if it is giving for 5 years, in a sense, 4,000 you will get it on each year. Okay, so for the accounting rule, what will happen? In a sense, recognize full revenue immediately. So once you're selling goods, the whole amount we need to record as per the accounting standard accounting rule. But for a tax rule, Tax is paid when installment cash is received. Say for example, we are selling this one, we are telling them, okay, within 5 months you can give 5-month basis, you can give each and every month, you can give for 4,000 like that. Okay, so once we are paying for the tax, what we will do, in a sense, we are receiving for 5,000, that 5,000 only we will calculate for the tax and we will pay. That is what tax rule. But accounting rule, what will happen, once we are mentioning for selling goods, in a sense, as the same amount we will write it accounting book. So it is higher and it is lower. So book profit is higher than tax profit. It means what, that is deferred tax liability arises. That is what we have given over here. Accounting income is higher while compared with taxable income. And next one, capitalization versus immediate expenses. This is the third scenario. So from the third scenario, if you're looking, in a sense, a company spent 12,000 on development cost. So from here it's available for development cost, in a sense, what it is an expenses. So development cost, accounting, as per the accounting rule, capitalize and amortize for 3 years. They mention for 3 years. 3 years, in a sense, each and every year. Okay, each and every year they will calculate. So 12,000 divided by 3, if you are putting, in a sense, 4,000 it will come each year. 4,000, 4,000, 4,000 and 4,000, it will be in 12,000. But as per the tax rule, what will happen, full deduction in the first year itself. So how you can record, in a sense, for accounting book you will record only for 4,000 because amortize for 3 years. So first year you will get it 4,000 expenses. For the development expenses you will spend for 4,000 only, and the second year you will spend for 4,000, the third year you will spend for 4,000. But as per the tax rule, what will happen, the 12,000 at one stretch you will mention for the tax book. So what it means, accounting profit is higher, taxable profit is lower. So what it means, from here expenses we mentioned, right? So once you are deducting this one, 12,000 minus 4,000, you will get it for 8,000 over here. Okay, and from here 12,000 for this one, and tax will be, taxable profit is lower only. So company pay less tax now, but future tax will increase. So but in the future what will happen, the tax will increase. The expenses lower here you need to deduct, okay, from here, from the development cost, what will be the profit is coming, from that you need to reduce that one, and after that you will get certain values. So while you are comparing that one, what will happen, in a sense, the taxable profit will be lower, okay, and accounting profit will be higher. Okay, so from this case what will happen, deferred tax liability will be arises. And now for the deferred tax asset, for liability we already looked. Right now we are going to look for deferred tax asset. Asset arises mainly, the most common, the single area is provision, that is provision for expenses. And some of the expenses we can look, that is provision for gratuity, provision for leave encashment, as well as provision for doubtful debts. Okay, gratuity, normally employee once they resign, that time only they will receive. As the same way, leave encashment, some companies they will pay before going for leave, and some companies they will pay once the employee utilize for the leave. After that they enter into a company, that time they will provide. So depends upon the company rule, it will be deferred. And provision for doubtful debts, that is also, that we studied for bad debts, and provision for bad debts and everything else. And from here, so these are all the main provision for expenses will coming under for deferred tax asset. For accounting book, what will happen, in a sense, the provision recorded as expenses immediately. So say for example, this year gratuity allocated for particular employee is 2,000, in a sense, from the accounting book they will enter. But from the tax book, what will happen, once they given to employee, after that only tax laws will allow deduction only when the actual amount is paid. Once the employee resigned, that time only we are going to pay for employee, that time only tax will be deducted. That is what tax rule. So right now you can understand how we are going to record for accounting book as well as for tax book. And from here you can look profit before provision 50,000, and tax book also same thing. Provision for gratuity from the accounting book they are mentioning for 10,000, but from the tax we are not give for any tax because we are not giving for the employee. Okay, and profit after provision will be 40,000, and from here 50,000, because 10,000 once we are deducting, in a sense we will get it for 40,000 over here, and from here 50,000 will come here. So accounting income will be 40,000, taxable income will be 50,000. So what company will do, the company will pay for more tax now, but in the future it will get for tax benefit when expenses is allowed. Okay, so from the right now they will pay, but in the future they will get for, because once they are paying for the employee, that time they not required to they can reduce on it. Okay, so that is what deferred tax asset arises. So such cases, what will happen? Deferred tax asset will be arises. So they will get the tax benefit because they are actually they need to pay for 40,000 only, but they are paying for 50,000 as per the tax book, right? But in the future, they can get the benefit of this 10,000 difference. Okay, so that's what we call it as deferred tax asset. I think right now you can understand the example of deferred tax liability as well as deferred tax asset. Now, what are the most common questions which is asked for school students as well as for those who are preparing for UGC NET and SET examination, in a sense? What kind of questions they are asking? That is what we are looking over here. The first question, deferred tax liability arises when accounting income is higher than taxable income. Correct. We looked for the difference, right? So that is correct. And deferred tax asset and liability are not actual assets or liability. Correct. That is not an actual asset. That is non-current asset and non-current liability. Non in a sense what? That is not a current asset. So that is what they are not actual asset and liability. This is also correct. So answer is both statement or true. The option A is correct one. And for the question number second, deferred tax liability arises due to liability they have given. Deferred tax liability arises due to permanent difference, temporary difference, capital profit, capital loss. It is a temporary difference only. Okay, it's not a permanent difference. Okay, temporary difference. So answer is B. And the next question, when accounting income is greater than taxable, accounting income is greater, okay, greater than taxable income, it leads to. So the first question, the first statement also we looked for over here. If you're looking in a same, the statement C arises when accounting income is higher than taxable income. It means what? Deferred tax liability. So from here, if you're looking in a sense, deferred tax liability, answer B is the correct answer. And for the next question, deferred tax asset generally arises due to accelerated depreciation, provision for doubtful debts, tax holidays, capital gains. That is a provision. So accelerated depreciation coming under deferred tax liability. Second one, provision for doubtful debts, that is deferred tax asset. So the answer is B. Okay. And which of the following creates deferred tax liability? So from here you can look which of the following is create. Provision for gratuity? No. Provision for warranty? No. These two coming under asset. And accelerated depreciation for tax purpose. This one is the correct one for deferred tax liability point of view. So the answer is C. And for the next question, which of the following is temporary difference? I already told you temporary difference in a sense what? That is a depreciation difference between books. See, donation and political parties, it will not. Fines and penalties, it will not. It is an expenses, it will not come. And income tax paid, it will not come. Depreciation differences between books and tax, it will come. That is a temporary difference. So the answer is C. Question number 7, deferred tax is calculated on permanent difference, which is already we looked, right? Right now you can look what is a different way they ask for the same query. So it's a permanent difference, it's a temporary difference, cash transaction, revenue expenditure. It is a temporary difference. So the answer is B. And the next question, deferred tax asset is recognized when Future taxable income is probable, loss occurs, cash flow decrease, profit decreases. What will happen? Deferred tax asset, the future taxable income is probable. We already looked at the tax benefit. Future tax benefit will get, so that is what the other word they have given, future taxable income is probable. So the answer is A. And ninth question, deferred tax should be recognized at historical cost, current tax rate, future enacted tax rate, market rate. So it means what? Future enacted tax rate. Deferred tax, how it will be recognized in a sense, future tax rate. Not for historical, not for current tax rate, not for market. So the answer is C. And question number 10, deferred tax liability represent future tax payable, current tax payable, permanent tax payable, cash liability. So it is future. Deferred in a sense, keep in mind it is postponed. Postponed in a sense what? Future. So future liability in a sense what? Payment. So it is payable. Got it? Deferred is postponed, it is future. Liability in a sense payment, it is payable. So future tax payable. So the answer is A. Okay. Now we looked 10 questions as well as for the theoretical meaning along with the examples. Now we are going to look for some of the questions for you. You need to comment below, okay, each and every question. Just you have to mention it, 1 for A, 2 for B, like that. Okay, you can comment below. That is very helpful to you also, okay, how you understood this respective topic, as well as in other also will know that once you study for each and every topic, and from this channel what will happen, every theoretical topic will be completed. I will frame for 10 questions each, minimum 5 to 10 questions. Then I will give you 5 questions to you to answer through the comment, as well as you can comment below suppose if there is any other topics required for finance, accounting, as well as for economics. Okay, so the first question will be, which of the following does not create deferred tax? Depreciation difference, provision for bad debts, donation, and warranty provisions. We looked from the theoretical. And question number 2, if tax depreciation is higher than book depreciation, the results will be deferred tax asset, deferred tax liability, permanent difference, capital reserve. And the next question, deferred tax is disclosed in the balance sheet under current liability, non-current asset or liability, capital reserve, contingent liability. And provision for leave encashment generally creates deferred tax liability, deferred tax asset, permanent difference, capital reserves. And question number 5, timing difference between accounting income and taxable income lead to deferred tax, capital gain, dividend, and reserve. So go through these 5 questions and you can put a comment below. This will be helpful for other student also, as well as I will know how you understood this topic also, whether you are answering correct or wrong. Okay, and thank you everyone, thank you for watching this. If you like this video, you can like as well as subscribe this channel and keep on watch for UGC NET as well as set examination preparation, as well as this will be very helpful for finance as well as accounting students for learning all terminologies. Thank you everyone, thank you for watching this. Bye.